Hello, everybody. Thank you for joining me on another episode of Powerhouse U. Today, I am accompanied by Tony Watson, and Tony Watson is a part of Robert Hall and Associates, and he is a tax professional here to give us great advice when it comes to commercial real estate, when it comes to filing your taxes. So, Tony, without further ado, please take the mic and let the audience know who you are.
Sure. Thanks so much for having me. Once again, thank you for the introduction. Tony Watson here on behalf of Robert Hall and Associates. Been in the tax preparation industry and public speaking industry for roughly about 18, going on 19 years. Our firm handles a number of tax filings, but I think we're servicing just shy of about 11,000 filings at the moment as a firm nationwide. So there isn't a state that we cannot file tax returns in. There probably isn't a state that we have assisted in real estate transactions in as well. Like I said, we have clients all over the US. We also assist in tax planning. I'd say that that's probably the most important thing on our end that we help our clients with is just dialing in or winding down the year. During tax season, everybody kind of knows how the previous year went, right? They know what their income was, what their expenses were. So that's pretty cookie cutter during the January 1st through April 15th months. But right in the tail end of the year, that fourth quarter is a very important time for all US taxpayers because they really have an opportunity to help reduce their tax liability for that calendar year just by putting a plan in place. So, a big part of what we do is year-end planning. And so we very much look forward to meeting with our clients prior to the end of the year so we know what their tax returns are going to look like. And that's where our true strength is in planning and implementing those strategies.
Yes, and right now we are in fact headed into the fourth quarter of the year. Once we blink, we're going to be there. This year went by way too fast, way too fast. So again, thank you for taking the time to meet with me today. I do have a couple questions for you in regards to taxes, of course, when it comes to commercial property. And then just to get right into it, the first question that I have for you is, what is the correct way to title invest property?
Sure. So a lot of clients tend to have these questions when they are initially starting the process of acquiring a property. Should they acquire it under their personal names? Should they acquire it under a corporation or an LLC? 98 to 99% of the time, normally it's under an LLC, a limited liability company. Some clients don't jump right into the LLC right out the gate just because they can't get financing under the entity name. They have good personal credit. They have good personal assets to leverage for lending purposes. But if you are purchasing a property outright cash, for instance, which is a very unique scenario, you got to have a lot of cash up front to do so. They normally won't run into those lending issues, right? So when you are buying a property outright cash, putting the title directly into an LLC, that's immediately from the get-go, from the very first date of you basically taking ownership of that property, you are creating great limited liability protection for yourself. The number one benefit of utilizing an entity like an LLC is asset protection. LLCs actually won't save you any income tax, but it will allow you to separate the business or the property liabilities from any personal liabilities that you and your partners may carry individually, right? Because one thing that we all have in common as people is an identification number, a social security number. And we carry risk and liability and also personal assets that are attached and filed under those personal social security numbers. So the benefit right out the gate, especially if you're buying a property outright cash, is to separate the liabilities of that property from everything that you have a risk and liability with personally. Now, most people won't have the cash to buy properties outright. They'll want to finance. So most of the time they'll have to acquire it personally because they have a personal credit score, they have personal assets. And so they're going to acquire the property, close on the loan, and then have the option of transferring title to an entity down the line. But you absolutely want to make sure that your lender at that point is okay with you transferring title, even though ownership really isn't changing. You individually are still owning the property, but you want the asset protection benefit of the LLC or the entity structure. But you always need to make sure that the lender's okay with that, right? Because the lender is utilizing your personal information, credit score, debt to income ratio, so on and so forth, to loan you the money. Well, if you have a new entity, it has no debt to income, it has no credit score. So you want to make sure that if there's a lender waiver of liability that you have to sign to transfer title, you want to make sure all of those ducks are in a row before you do so. So titling property is really important from an asset protection standpoint, not so much from a tax saving standpoint to start with. There could be some tax advantages down the road, depending on the cash flow benefit from the property, other assets that you have kind of flowing or cash flow flowing through that entity from other business ventures, so on and so forth. But that's where we step in and advise on when the right time is to set up that entity structure for titling purposes. Most people, when they title it personally, you'll just want to make sure you have a really kind of fine-tuned insurance policy to protect you in case, heaven forbid, anything happens with your tenants or anything personally happens with you where there is potential litigation on the personal side. You want to make sure that you have those assets separated in the risk and liability protection.
Okay, which sounds good. So, from what I gather from that, insurance is important, especially if you are the sole owner on the property. LLC does not provide a tax benefit. It only provides a safety net in case anything happens at the property, and you won't be out millions of dollars based on, anything that may have happened. In addition to, we talked about taxes, of course, and how depreciate. Well, actually, we haven't talked about depreciation yet. I'm actually getting ahead of myself. So let's actually get into that. And the depreciation when it comes to the property, whether you own it as a sole owner or a LLC, depreciation, good or bad? Is there more than one kind when it comes to depreciation?
There is. Depreciation is actually a very unique part of the Internal Revenue Code. The way that the code is written is that when depreciation is allowable, it must be taken. I've had many conversations over my career with new clients, with current clients, people who have filed many years of returns and people who are new into the real estate world. Everybody seems to be concerned with, but also a little intrigued by the benefit of depreciation, because from the get-go, depreciation sounds like a fantastic thing. It's depreciation is basically the value of the building that you purchase, not the land value, but the building itself. So let's say you buy $1 million property, and let's say the land versus building ratio is 70-30, 70% building, 30% land. The 30% land you can't do anything with. Land is just land. It's a valuable asset, but it's not a write-off. Only the property taxes are on the property as a write-off. But the building itself can have a what I call a phantom write-off, which is the value of the building. In this scenario, it would be $700,000 for the building. And you get to take that building and write it off. The value of the building, you get to write it off over the next 39 years for commercial and 27 and a half years for residential. And what that means is that you take this $700,000 number, which is the building value, and you divide it by 37 or 39 years, and you get that dollar amount as a write-off every year from now until the end of the 39-year period. That's a phantom expense. You're not coming out of pocket for that expense. It's not something that's like an actual cash transaction. It's just a benefit that the government allows rental real estate owners to take as this phantom expense to offset cash flow. Now that sounds great, right? You're like, oh, I'll take all the phantom expenses I could possibly get,
It
whenever they're
does.
available,
And then
right?
can I interject real quick and ask you, does it depend on the type of property that you own, or is it 39 years for all properties across the board?
Commercial only. So if the property is zoned as a commercial space, and sometimes, especially here in Southern California, you'll have like a live and workspace. So
Mhm.
there might be an allocation of commercial space versus residential space.
Right,
But
in reference to whether it be industrial, retail, multifamily, all of those are in that's all what I think of as commercial. Can you write all those off?
so what you just said there, that good point. Residential. So let's say you have a 40-unit building. That is
Hmm.
actually not commercial. That's residential because that's living space for people where they have those as their primary residencies.
Okay, so
So that would
anything
actually
but.
be 27 and a half years for
uh,
the 40-unit building. Mhm.
okay, so okay, you said that will be 27 and a half.
Correct. Yeah.
Okay, so
Residential is a 27 and a half year lifespan.
Okay, so they could both be written off, but it varies with the amount of time depending on what type of asset you own.
That's correct. That's correct.
Okay, okay, got it. All right, sorry, I hope you remember where you left off. You could go
Sure.
ahead.
Sure. No, depreciation is kind of a little bit of a rabbit hole conversation, but I'm going to try to shorten it and make it as clear and concise as possible.
Mhm.
It sounds great in theory, right out the gate. And like I said, whether you want to take it or not take it, it has to be taken because the code specifically states that when depreciation is allowable, it must be taken. But, it's a great phantom write-off. But let's say that 10, 15 years down the road, you decide that you want to exit out of real estate altogether. You're not going to exchange the property. You're not going to do a reverse mortgage on it or anything. You just want to be done with the real estate transaction. All of the years that you had taken depreciation and taken that as a write-off and saved yourself income tax on, when you sell the property outright, you have to add all of those years of depreciation up. So let's say it's, $500,000 that you took over the last 15, 20 years. You have to take that $500,000 amount and add it back onto your return in the year of sale and pay tax on it as ordinary income. So it's called recaptured depreciation. And this is what really drives a lot of real estate investors to not sell or liquidate real estate, but to actually enter into a 1031 exchange, which allows you to defer all of the liabilities, the tax implications on the property, as long as you're cycling the profit from that sale into another like kind investment. So there are great exit strategies. That's where we as tax professionals come in and advise you on all of this, to make sure that you're not paying unnecessary tax. Depreciation, however, when you are cash flowing on a property, is a massive write-off. Now, I talked about how you can divide depreciation over 27 and a half years for residential, 39 years for commercial. Some people will say, well, I don't want to wait 39 years to get those write-offs. Is there any way for me to accelerate that depreciation and take it all in this year, especially if I have crazy cash flow on my property? Absolutely. There is an election that you can make called cost segregation. We here at Robert Hull and Associates don't actually make those elections. We do the election on the tax return, but there's a whole third party analysis that needs to be filed. And so you'll have to, we have great referrals for cost seg, by the way, but cost segregation is an election with the IRS to take future year depreciation all in this year, to accelerate those write-offs, to take it all in this year. So as you can imagine, instead of taking, let's say, a $20,000 depreciation write-off this year, if you have crazy cash flow for this year, wouldn't it be much better to take $150,000 to $200,000 of depreciation, save yourself the tax money this year, take that tax savings and buy more real estate? Absolutely. Because now you have a new investment, new cash flow opportunities, and then also new depreciation, new mortgage interest, new property tax write-offs, and now you've got to double down on your investment. The kicker here is that when you get ready to exit out of those investments, the strategizing and the planning ahead, it's a must. Because the goal here in real estate is to build wealth, and at the end of the life of the investment, to figure out very creative ways to avoid paying tax on all of that gain, not evade. Remember, tax evasion is illegal. Tax avoidance is not, right? So
Right,
let's figure out
right.
creative ways to avoid tax. Mhm.
Okay, which is great. So, when talking about taxes and 1031 exchanges, can advising on a 1030, can advising on an exchange garner additional transactions?
Absolutely. For real estate professionals, I've seen this once again, 18, 19 years of being here at Robert Hall. I've seen the advice that we give, not only realtors, real estate professionals, but also individuals who are syndicators. We've been doing a lot of tax returns for syndications as of late. And when we tell people about the 1031 exchange, some people will say, oh yeah, I've heard of the 1031 exchange before. I know how it all works. But you'd be surprised at how many people have never actually heard of Section 1031 of the Internal Revenue Code. That's what I know it as, but the general public will know it as a 1031 tax deferred or like kind exchange.
Mhm.
And this allows people to exit out of their properties either for greater or higher valued properties. So you can do an up leg exchange where you take, I don't know, $1 million property and you exchange it for a $2 million property, and you're acquiring debt in the deal or bringing cash to the deal so that you don't have to acquire more debt. There's no tax implication on that. The most common is the like kind exchange, just $1 million for $1 million. I mean, there's a couple other adjustments that, closing costs and whatnot that you calculate in there, but that's the most common, just $1 million for $1 million. Maybe you got a $1 million warehouse here in California. You want to exchange it for a 10 unit building in Arkansas for $1 million, right? So now instead of having one stream of revenue, you have 10 units generating revenue, right? So like kind exchange, $1 million for $1 million.
Mm-hmm.
Then there are very creative exchanges like the down leg exchange, which, let's say I've got that $1 million warehouse here in Southern California, and I need to pay off student loan debt, or I need to pay off my primary mortgage, or I need to just access cash for any given reason, right? I can go from that $1 million property into, let's say, a $700,000 property and only access $300,000 of the gain. Once again, the calculation is a little bit more complicated, trying to make it easier to understand here. But let's say I only need to access a portion of it and take the rest of it, the rest of the gain, and defer it into other real estate. Now, instead of paying tax on the full gain, I'm only paying tax on a portion of it, only the amount that I need to access to pay off personal debt or to do other things with my cash. So there's the up leg, the down leg, and then just the straight up even exchange. But all of that really requires a lot of planning. Now, when we advise our clients about the exchange and it allows them to save all of this money in tax, especially if we're talking to a realtor and the realtor goes to their client and says, hey, the accountant that I work with says, hey, this 1031 exchange will allow you to avoid paying the capital gain tax and recapture depreciation tax. All of a sudden, I mean, that client of the realtor is just like, wow, that could save you in potentially in certain situations, hundreds of thousands, if not millions of dollars, depending on how much gain you're looking at, right?
Right.
Well, they basically just won the lottery, but simply by just being advised on the 1031 exchange side. So I've had a lot of realtors in my career call me back and say, hey, listen, thank you so much for that advice, because this client over the years has been a nice referral source for me. And simply because I told them about the option of the 1031 exchange, they told me, this is my client telling me this, they've told me that I'm going to be their realtor from here until the end of time. And then they're going to refer their friends and their other business investor partners and whatnot. So yeah, I mean, simply just by knowing your options, that's really key in the tax industry. I'm not expecting everybody to know the Internal Revenue Code. I get paid to know it as an accountant, right? But if you're in real estate and you just don't have time to read the hieroglyphic Internal Revenue Code, right? Because it's very much another language that you'd have to learn. You pay your accountants to learn it for you. And just a simple, 20-minute conversation on the phone with an accountant could be worth millions of dollars in tax savings. I've seen it many times in my career. I know the other senior executives here at our firm, they've seen it as well. And that really makes us feel good about what we do, because we help people retain wealth. That's really what I want people to understand, is that you might see it as saving tax. I see it as the same thing, but I approach it from a wealth retention perspective. If I can save somebody $10,000 in tax, they view it as, hey, I got to pay $10,000 less in tax. I think to myself, I'm like, I just helped that client keep $10,000 in their own bank account rather than spending it, what I consider overspending with Uncle Sam in the state, whatever state they're filing in. So wealth retention is key in tax planning, in my opinion.
Tax planning for anybody, as an individual, as a landlord, no one wants to pay taxes.
Absolutely.
All right. And then when it comes to a down leg in a 1031 exchange, you only pay taxes on the portion you did not do the 1031 on, right?
Correct. Yeah.
Okay.
So whatever you're accessing, and like I said, it's a pretty complicated calculation from an exchange calculation perspective. We have really nice spreadsheets and calculators here in our office that we use.
Mm-hmm.
But yeah, it's only the portion that you're accessing. Everything else, you have the option of kicking down the road. I always tell people exchanging is like kicking the tax can down the road and until you kick the can, right?
Mm-hmm.
That's always a funny expression, because you want to defer that gain as much as possible while you're still alive, but not accessing monies to where you're paying the government an exuberant amount of tax, or it's bumping you up into a higher income bracket. And now you're just flushing money down the government drains, right?
Mm-hmm.
So we want to make sure that we're calculating it correctly to where the tax implication on the money that you're accessing.
We or
And
you? Will you want to make sure we calculate it correctly, or you?
no, that we calculate it correctly for our
Okay.
client, but so that they have all of the pieces of the puzzle, right?
Right.
Because the worst feeling in the world, and I haven't been in this situation because I've been doing taxes for a long time, but I have a lot of clients who have filed taxes for 20, 30, 40 years. And when they get hit with this large liability because they forgot to plan, right? Failing to plan is ultimately planning to fail. We've all
Mm-hmm.
heard that phrase. And so people start kicking themselves during tax season because they failed to plan ahead for this large liability. Well, that's the importance of year-end planning. If I can tell my client, hey, if we have this option A, B, or C, here is where you pay the most tax. Here's where you pay the least amount of tax. But this is where you access, this is kind of a middle ground where you're accessing enough money to achieve what you want to do while paying the bare minimum obligation in tax. Maybe that's the right route to go. Well, if we can get that plan in place prior to the end of the year, then when we file the tax return, whatever the liability is on the money they are accessing, they already knew about. Right.
Right.
And they can set aside part of that gain that they've accessed to pay for the tax. They know what cash is available to cycle back into another investment or to pay off debt. And then they feel comfortable because they know that they can make it work financially. Right.
Right. Yes.
The worst case scenario is for somebody to sell a property, not really understand the tax implications. And when they come to file their returns, we're saying, hey, you got to pay the government X amount of tax. And they're thinking, man, was there anything that I could have done? Well, sure. There's a lot that we could have done if we met during that calendar year. But now that it's 2023 and we're filing for 2022, there's very little that we can do for our clients. I mean, a couple strategies here and there, but all of the planning has to be done in that calendar year to properly avoid tax and not evade.
Which actually, it sounds like you just answered the question that I was going to ask you next, which is the most common mistakes that landlords make when it comes to filing taxes. So it sounds like you just answered that for me, which is great. And this was actually a learning call for me. So I actually am the questions that I have for you, you answered from my perspective. However, at the same time, I do want to open the mic to you for you to give any extra information that you could give to either myself or the landlords who will be watching this video, any advice when it comes to filing taxes. And
Sure.
feel free to give your information.
Okay. Two really important things that I didn't cover in what I just explained. One thing that is actually new as of 2020 for commercial investors is something called qualified improvement property deductions. And it specifically is only for commercial investors. During the pandemic, the first year of the pandemic, the federal government wanted to create a benefit for the restaurants and the salons and the businesses that were being shut down because of COVID, right?
Mhm.
And they wanted to make sure that while they were shut down for those months, if there was a way for them to make improvements to their commercial property so that when the economy did open back up, they not only were making all of these improvements and saving on tax, but now they had a newly improved commercial space once the economy did open back up to, bring or attract new business revenue, right? So qualified improvement property, also known as QIP, QIP, is the benefit without doing that cost segregation election that I mentioned earlier. It is simply the ability to accelerate all interior improvements in your commercial property dollar for dollar in the calendar year. Meaning that if I had a restaurant and it shut down for, I don't know, 6 to 8 months during the pandemic, but I needed a new kitchen, I needed new lighting, I needed new furniture, I needed to, put in new drywalling and electrical outlets, all of those interior improvements technically would be depreciated under the old Internal Revenue Code prior to the pandemic, but because they are interior improvements under the QIP now part of the Internal Revenue Code, I can take that, let's call it $100,000 improvement, I can take it dollar for dollar as an expense in the calendar year. And to go above and beyond that, the federal government said on top of QIP, if you had made those improvements in 2019 or 18, you can actually go back and amend those returns and take all of the expenses that you were depreciating fully in those years and possibly get refunds from years prior to the pandemic. So, and a lot of clients didn't understand that about the changes in 2020 because there were a lot of changes, right? The stimulus checks and the Affordable Care Act and like all of these, I'm sorry, oh gosh, the act that was passed in 2020 because of COVID, and all of those changes. I mean, there were a lot of changes in 2020. There were a lot of changes in 2021. There will be a lot of changes in the new Internal Revenue Code. But for commercial investors, I found that was such a huge benefit for a lot of my clients, especially the restaurants, the salons, even small boutique agencies here in Southern California and across the US. They were really able to take advantage of that completely. That was one. And then for the property managers in the room, I'm sure that you're all aware that you are self-employed, right? You're not getting paid W-2, at least most property managers aren't. And as a self-employed property manager, you want to make sure that if you are getting paid self-employed revenue streams, meaning that your income that you're receiving is subject to federal, state, and self-employment tax, you absolutely want to open up the conversation with your accountant about incorporating yourself to reduce the amount of self-employment tax that you're paying. Self-employment tax alone is 15.3%. That is what you contribute to Social Security and Medicare on a year-to-year basis. And if you are meeting certain strides in net profit as a property manager, making $45,000, $50,000 of net profit, so after expenses, if you're making 45 to 50 grand of profit consistently each year, you could be leaving a lot of money on the table with Social Security and Medicare. So open up that conversation with your accountant, because simply by incorporating yourself as an S corporation, for instance, it could help you save close to $5,000 in tax. If your profit's at about 45,000 to 50,000, the tax savings by filing as an S corporation is just shy of about 5 grand. If you're making 100 grand in net profit after expenses, your tax savings is more like $10,000 just by simply filing as a subchapter S corporation versus a sole proprietorship. I don't want to confuse you about all of the terminology. I just want you to understand that if you are self-employed, have the conversation with your accountant about when the right and wrong time to incorporate is, and hopefully retain wealth and not overspend with Uncle Sam in Social Security, Medicare, federal, and state income tax. Okay.
Yes, which is a lot of great information. I appreciate it personally. I do the Zoom calls often so I could learn too, and be connected to a lot of individuals such as yourself when doing this. So I do want to thank you, Tony, for your time. And then in wrapping up, like I said, feel free to give any information you feel is important. And of course, if you have any information you could provide, I will. Well, let me talk to the landlords here who are listening. The information that Tony gives me, I will be putting in the description of this video for you to read any type of material that you need, and to also contact him in the event you need assistance filing your taxes, or if you have any questions regarding any of the information that we just discussed here. So with that said, Tony, take it away.
Sure. So our website is a great tool for some downloadable materials. roberthalltaxes.com. If you go to the top part of our webpage, there's a tax forms tab that you can click, and we've got lists of expenses for corporate entities, for sole proprietors, for real estate professionals, for rental property owners. So there's a lot of downloadable kind of PDF fill and print tools that you can print out and kind of gauge what is deductible for your business and what's not deductible, so on and so forth. But really where the main advice comes from is our free consultations. The best way to get in contact with us is just to contact our office directly. If you're living in the digital world and you're always on the phone throughout the day and texting is easier, you can text the number, text the words Robert Hall to the number 72,000. So if you just open up your texting and you type in the number 72000 and you text Robert Hall to that number, it will automatically prompt you to fill out information for the 30-minute consultation. We don't sell your information. Your information is completely secure with us. And so it's just to reach out to you to get you set up with the free consultation. That I can tell you, 30 minutes might not seem like a lot of time, but try us. Challenge us, ask us those questions, because I guarantee you will be pleasantly surprised with the amount of information we can cover in just a short 30-minute period. And if our connection is great, if you feel like you'd work really well with our firm, we'd be more than happy to help out and assist with future tax filings.
All right. Well, there you have it, guys. Tony, as you could tell, is very educated when it comes to tax filing for both landlords and LLCs, and he even helped out the property manager. So all this information was very valuable. I also want to thank Tony myself, who in fact educated me on this, because it is a lot of information. So once again, thank you for joining me on another episode of Powerhouse U, and I'll be back with you with another episode next week. Take care.